What's going on, everyone? It's XXX and welcome back to the channel. Today we're diving headfirst into the exciting world of Forex, which, by the way, is short for the foreign exchange market. For those of you who are new to this, Forex is literally the biggest financial market on the planet. We're talking trillions with a T of dollars exchanging hands every single day. That's bigger than the stock market, bigger than the bond market, bigger than everything combined. Now, you might be thinking, that's cool and all, but what does it actually mean for me? Well, that's exactly what we're going to break down in this video. We'll uncover how this whole Forex thing works, why it even matters, and most importantly, how you can set yourself up for success in this fast-paced world of currency trading. Whether you're a complete beginner or you've dabbled in stocks and crypto before, stick around because things are about to get interesting.
Now, before we get into the nitty-gritty of trading, let's start with the absolute basics. Currency pairs. Think of these pairs like the atoms of the Forex universe. Every time you make a trade in Forex, you're essentially buying one currency and simultaneously selling another. It's always a two-way street. These currencies are represented in pairs, like EUR-USD, which is the euro against the US dollar. This pairing basically tells you how much 1 euro is worth in US dollars. Let's say the EUR-USD pair is trading at 1.10. This means that to buy 1 euro, you'd need to shell out 1.10 US dollars. Pretty straightforward, right? Now, the first currency listed, in this case the euro, is called the base currency, and the second one, the US dollar, is the quote currency. When you're trading Forex, you're basically betting on whether the base currency will go up or down in value against the quote currency. If you think the euro is going to strengthen against the dollar, you'd buy the EUR-USD pair. On the flip side, if you believe the euro's in for a dip, you'd sell the pair. And get this, there are tons of currency pairs out there to trade, not just the euro and the dollar. You've got the Japanese yen, the British pound, the Swiss franc, the Canadian dollar, the Australian dollar, you name it. Each of these currencies is influenced by a whole bunch of factors, like economic data, political events, and even natural disasters, which is what makes the Forex market so dynamic and, let's be honest, a little bit addictive. So, we've got these currency pairs duking it out in the market, but who are the big players making these trades? Well, the Forex market is like a giant cocktail party with a guest list that reads like a who's who of finance. First up, you've got the heavy hitters, the central banks. These are the institutions responsible for a country's monetary policy, like the Federal Reserve in the US or the European Central Bank. They're like the referees of the Forex game, setting interest rates and controlling the money supply, which, believe me, can send shockwaves through the entire market. Then, you've got the commercial banks. These guys are the ones facilitating most of the trades between their clients, which include everyone from giant corporations to hedge funds. Think of them like the brokers of the Forex world. Speaking of corporations, they play a massive role in Forex too. They need to exchange currencies constantly for international business deals, like importing goods or investing overseas. And of course, we can't forget about governments. They're always in the market, buying and selling currencies to manage their foreign exchange reserves and influence the value of their own currency. And finally, you've got retail traders. That's us. We might not have the same firepower as the big banks, but with the rise of online trading platforms, more and more individuals are jumping into the Forex game, hoping to profit from those currency fluctuations.
All right, let's talk about what makes Forex truly unique. It's a 24/5 market. I'm talking non-stop action, folks. Unlike the New York Stock Exchange or the Nasdaq, which have set trading hours, the Forex market is open for business around the clock from Monday morning in Sydney, Australia, all the way to Friday afternoon in New York City. That means you can literally trade currencies while you're sipping your coffee in the morning, during your lunch break, or even in your pajamas before bed. Not that I recommend that last one. This continuous trading is possible because of the interconnected network of financial centers spread across different time zones. When the trading day ends in one part of the world, it's just getting started in another. This creates a highly liquid market, meaning you can easily buy or sell currencies at any time without worrying about finding a buyer or seller. Now, this 24/5 nature of Forex can be both a blessing and a curse. On the one hand, it gives you incredible flexibility to trade whenever it's convenient for you. But on the other hand, it also requires serious discipline and risk management because the market is constantly moving, even while you're sleeping.
So, you're ready to jump into the Forex market and start trading currencies. But where do you begin? Well, it all starts with understanding the different trading instruments at your disposal. The most common way to trade Forex is through the spot market. This is where you're buying and selling currencies at the current market price for immediate delivery. It's like walking into a currency exchange booth at the airport, except you're doing it all online with the click of a button. But there are other ways to trade Forex beyond the spot market. For instance, you've got forwards, which are contracts that lock in an exchange rate for a future date. This can be a great way to hedge against potential currency fluctuations, especially if you're a business dealing with international transactions. Then you've got options, which give you the right, but not the obligation, to buy or sell a currency at a specific price on or before a certain date. Options can be a bit more complex, but they offer greater flexibility and the potential for higher profits, though with higher risk, of course.
Forex trading instruments, spot market, forward contracts, Forex options.
Now, let's talk about one of the most alluring yet potentially dangerous aspects of Forex trading: leverage. Leverage is basically like borrowing money from your broker to amplify your trading positions. It's like having a superpower that lets you control much larger amounts of money in the market than you could with just your own capital. For example, with a leverage ratio of 50 to 1, for every $1,000 you put up, you can control a whopping $50,000 worth of currency. That means even a tiny move in the market can translate into significant profits or losses. And that's the catch with leverage. It magnifies both your wins and your losses. While leverage can juice your returns, it can also wipe out your entire trading account faster than you can say currency exchange. That's why it's absolutely crucial to understand the risks involved and use leverage responsibly. All right, let's face it, no one likes losing money. And in the world of Forex, where profits and losses can fluctuate faster than a roller coaster, having a solid risk management plan is absolutely essential. It's like wearing a helmet when you're riding a motorcycle. You might not always need it, but when you do, you'll be glad you have it. One of the most effective risk management tools is a stop-loss order. This order automatically closes your trade when the price of a currency pair hits a certain level that you set beforehand. It's like having an insurance policy that limits your potential losses on a trade. Another crucial aspect of risk management is position sizing. This refers to how much of your trading capital you allocate to a single trade. A good rule of thumb is to never risk more than 1 to 2% of your account on any given trade, no matter how confident you feel. Remember, Forex trading is a marathon, not a sprint. By managing your risk effectively, you'll be able to stay in the game longer and weather those inevitable market storms.
Now, let's talk about something that's often overlooked, but is absolutely crucial in the world of Forex regulation. See, unlike the stock market, which has clear-cut rules and regulations, the Forex market has historically been more decentralized and less regulated. But that doesn't mean it's a free-for-all. In recent years, governments and regulatory bodies around the world have stepped up their game to bring more transparency and accountability to the Forex market. For example, in the United States, the Commodity Futures Trading Commission, or CFTC, plays a major role in overseeing Forex brokers and ensuring they're playing by the rules. The goal of these regulatory bodies is to protect traders from fraud, manipulation, and shady practices. They also set standards for things like leverage limits and capital requirements for brokers to ensure a level playing field. When you're choosing a Forex broker, it's crucial to make sure they're regulated by a reputable authority in your jurisdiction. This will give you peace of mind knowing that your funds are safe and that the broker is subject to certain standards and oversight.
So there you have it, guys, a crash course into the ins and outs of Forex. We've covered a lot of ground today, from understanding how currency pairs work to navigating the world of leverage and risk management. Remember, Forex trading can be incredibly rewarding, but it's not a get-rich-quick scheme. It takes time, dedication, and a willingness to learn and adapt to the ever-changing market conditions. But with the right knowledge and strategies, you can definitely set yourself up for success in the world's largest financial market. Make sure to subscribe and hit that notification bell so you don't miss out on future videos where we'll dive deeper into specific trading strategies, indicators, and all the tools you need to become a Forex pro.